Let's get to the latest. Investors are awaiting President Trump and Chinese President Xi Jinping's meeting at the G20 summit in Japan this Friday. Now, this coming as a new Morgan Stanley note saying that the U.S. economy is experiencing a material slowdown, adding that markets could see a 10% correction if weakening economic data continues to deteriorate into the third quarter. Joining us now is Alfred Eskandar, president of SALT Financial. And Alfred, when you take a look at Morgan Stanley's warning, just the fact that we could see economic data further deteriorate, that could, of course, then provoke a correction. What do you think the odds are that that actually plays out and happens?
Well, it happens more often than we think, right? Typically, 10% corrections after a long run-up are kind of normal for markets. In fact, almost healthy. So, I would tend to agree that that is a likely outcome.
What do you think about earnings as we look ahead and just try and figure out whether or not we're going to see another or if we will see a material slowdown? We know that we were expecting a huge slowdown that didn't really come to fruition over the first and second quarters. So what do you see as we enter the third?
So we had a lot of negative news coming out at the end of the year, expecting earnings to be down, I think, roughly 4%. And they were less than 0.5%. So there was a positive result there. Going into the second quarter, we have the same kind of negative sentiment. The good news about what we do is we're quantitatively driven, so we don't have to be so sensitive to sentiment, but rather actually take a look at the actual sensitivity of stocks and sectors to the relative market. And what we see is a flight into safer areas of the equity space. By that I mean lower risk, less volatile products, sectors, and individual stocks.
How much does trade goes into your forecast when you're trying to figure out whether or not we're going to see some sort of material slowdown in the second half of the year? If we do get some sort of resolution, I know it's not likely, but if we do get some sort of resolution in the short term, does that mean that we could see the markets really take off here in the second half?
So I'll give you an example of that, how that impacts kind of the market. Energy has been on fire the last week and actually the last few weeks. That's been a huge benefit to us because we were overly weighted in energy in our high beta fund. That's now gone into Q3, and if you look at what's going on between the U.S. and Iran, that is going to be a pretty volatile sector for the quarter coming up, and that's not where low conservative clients and portfolios want to be positioned.
So do you think as we hover near the all-time highs, is all the good news already priced into the markets then, would you say?
I think this is one of the least loved bull markets I could recall in my 25 years doing this.
Why do you think that is?
I have no idea. I think people over time just want the opposite of what's been happening or can't believe a good time could continue for so long. And it's just human nature to start fearing what you've accumulated because the sentiment of fear is way greater than greed. And I think right now folks are looking at gains and saying, hey, I don't want to lose what I have, but I don't want to miss out. So let me position the portfolio more conservatively and put some more stuff in less risky assets, but still keep my exposure because I don't want to lose out.
How much of this has to do with the Fed's next move when you take a look at whether or not the Fed is going to cut rates, trying to determine that? Do you think the Fed should cut rates at this point when you take a look at the recent economic data we got and then also the geopolitical risks that the U.S. economy is facing? Yeah,
the Fed's in a tough spot because no matter what they do, everybody gets to play Monday morning quarterback. We can look back at what happened at the end of 2018 and go, wow, you should not have raise rates, look what you did. But now you look at what they've said early in the first part of 2019, and certainly the comments from the last speech saying that they are losing patience, they would be open to a cut and the market rallies. So we're definitely a Fed-sensitive market, and we're waiting for every word that comes out of Chairman Powell's mouth. I do think there is a cut, and I would probably, if I was a betting man, greater than 50% chance, at least one by the end of the year, and I think consensus maybe even has by two.
Focusing on G20, President Xi and President Trump are expected to meet later on this week. Do you expect any progress here, substantial progress on trade between those two?
I don't, and the reason being, you don't get that much done at a meeting of this caliber. There's so many other agenda items. And further, look what has happened. I mean, we've had over a year worth of negotiations that really unfolded because of, time to sign. And I think it showed China's not ready yet given what the U.S. wants. And I don't do this often, but I will give the president credit for this one. I believe the tough stance is the right stance, and that's why I'm not really overly optimistic about what happens out of a single meeting.
I know a lot of people would say that maybe the tough stance is the right stance right now, but how long do you think President Trump is willing to push this? Because if we don't see China back down and if we do see our economy slow down a little bit, that, of course, is something that President Trump is riding on going into the 2020 election.
Yeah, I think it's a question of who gets to blink first. We're definitely slowing down, but so is the rest of the world. And ultimately, you have to make a decision based on options presented. And as far as I can see, we're still the U.S. Equities market, still the best option, given all the other options considered.
All right, Alfred Eskandar, thanks so much for stopping by today.
Great to be here.